Ready to simplify your charting and spot the real market trends? You should be. In this video, I'm revealing the power of moving averages, an incredibly effective yet often underused tool. By the end, you'll know how to pinpoint high probability trade setups, cut through the noise of false signals, and use moving averages like a pro for identifying trend direction, support, and resistance. Stick around, this one tool can transform the way you read markets. This is a chart of XAU/USD on a 4-hour time frame. Any of the technical tools and indicators that I show can be used on any currency pair, any asset class, any time frame, any financial market. So now I've added the moving average to the chart, which is a exponential moving average. You've also got simple moving averages, linear moving averages, weighted moving averages, and so on. But for this example, I'll look at showing exponential moving average. So currently, if we look at this section here on the chart, you can see the moving average is quite a distance away from price. So if we double click, we can see that the period of the moving average is currently set at 50. If I reduce the value, to 5, and now you can see that the moving average is a lot closer to price. So when you have a shorter period moving average, the moving average will be closer to price and more sensitive to market movements. Whereas if I change the reading back to, if we have it at 60, you'll notice price, the moving average is a lot further away from price and it's less reactive to price movement. There's quite a number of ways that you can use moving averages in your strategy. Here, I'll be showing how to use one moving average to help determine market trend direction. In your rules, you could state that if price is trading above the moving average, which you can see here, our moving average here is the blue one. If price is trading above the moving average, then that would mean that we are in an uptrend. If we're in an uptrend, in your strategy, you could state that when you're in an uptrend, you will only take buy signals. The way that you'll benefit from that is you won't take sell signals. So here we have a bearish engulfing pattern, but because price is trading above the moving average and you've determined that you're in an uptrend, you won't take that signal, so you'd save yourself some money. So that's an example of how to use a moving average to determine an uptrend. Again, if price is above your moving average, then you'll say that you're in an uptrend. Whereas you can also say if price is trading below the moving average, then I'm in a downtrend. There's pros and cons to that. So the pros are that you can get in moves quite early, but the negatives is that sometimes you'll be in a choppy period around here. But that's just one way of using a moving average to help determine market trend direction. We looked at a way how to determine market trend direction with the use of one moving average. However, when price is choppy and going up and down, we notice that we have a lot of signals where the market's telling us that we're in an uptrend and a downtrend. A way to combat that is by the use of two moving averages. So what I'll do, I'll just click on this. Currently, the fast moving average in blue is set to 60. And so what I'll do, I'll change that to a faster period. I changed from 60 to 20. So now it's going to be closer to price as it's a shorter period. And the second moving average that we'll add is going to be a 40 period. So we have a 20 period in blue, and the second one that I'm going to add now is going to be a 40 period. So the 40 period will be slower as it's a larger period number. We'll turn that on. Now we can see we've got two moving averages on the chart. It's a lot simpler to determine market trend direction with the use of two moving averages, because what we'll say when the faster moving average is above the slower moving average, then the market's in an uptrend. Or you can say when the blue moving average is above the red moving average, you're in an uptrend. Or when the faster moving average in blue here is below the slower moving average in red, then you're in a downtrend. So when you have two moving averages, in this period here where we wasn't certain which way the market was going, or if we were in an uptrend or a downtrend, now we can see we were in an uptrend all the way until the blue moving average crossed below the red moving average. At this point, now we're in a downtrend. The way that trend is beneficial to us when we trade is because if we know the direction, the overall direction of trend that the market's in, if we trade in the direction of the trend, we have a higher probability chance that our trades will be profitable. Whereas if we trade against the trend, then we have a higher probability chance that our trades will be in loss. So when you're in an uptrend, ideally you'd like to be taking buy signals. And when you're in a downtrend, ideally you'd like to be taking sell signals. Because here we can see that we have a bullish engulfing pattern here, but the market's in a downtrend. So again, that's a reason as to why you shouldn't take the trade. You'd have saved money if you follow the rule set of only trading in the trend direction. Just to add, you don't need to use the periods that I used on the moving averages. You don't need to use the colors either. You can use any colors, any periods. It's simply your preference. Whichever you do decide to use though, make sure you thoroughly test them before trading in live markets. As a bonus, you can also use moving averages as a way of support and resistance. For that, you don't need two moving averages, you just need one. It works better with a longer period. So if we go back, we can see we've got a 20 and a 40. We'll just get rid of the fast moving average. So go to style, remove that one. Now we've just got the 40 period moving average. Again, you can use any period moving average. Just go back in time. And now you can use the moving average as a way of support. So we can see that price broke above your moving average and you're in an uptrend. You can see that price touches your moving average here. And we also have a bullish engulfing candlestick pattern, which is a key reversal candlestick pattern or a buy signal. That could be a reason to enter the market, enter the position for a long signal and make profit. Also happens here when price retraces and touches the moving average. You have a bullish engulfing candlestick pattern, so that's another buy signal. Here we have price breaking and going below the moving average. Then we have a bearish engulfing pattern, or it's an evening star pattern. You have another bearish engulfing pattern which is touching here, and a bearish engulfing pattern which is touching here, and you could have made the profit. So that's how you can use moving averages as a way of support and resistance. Now you should have a better understanding of moving averages and how to apply them to your trading strategy that can help improve your risk management and overall trading performance. The traders I've mentored have used these exact techniques to immediately boost their results. For even more trading resources, head over to my website and join my free Discord where you can grab strategy PDFs and other helpful content. I'll leave the link in the description below. If you're craving deeper insights, I also run a private trading group packed with in-depth strategies and live analysis. You get to ask me anything. Plus, I offer personalized mentorship to help you master these concepts in a fast-track way. Stay tuned for more because I'm always dropping fresh content to sharpen your trading edge. See you next time.